Welcome, everyone. Today, we're unpacking a truly fascinating puzzle together, the world of behavioral finance. We're going to explore exactly what happens when the messy, unpredictable reality of human bias collides head-on with strict institutional constraints. So if you've ever looked at the financial markets and wondered why they sometimes seem completely detached from reality, well, you are absolutely in the right place. Let's get into it. Here's our roadmap for this explainer. We're going to systematically move through 5 key areas. First, the efficient market benchmark. Then, the limits of arbitrage. Next, volatility, noise, and bubbles. After that, investor biases and herding. And finally, we'll wrap up with the ethics of gamified trading. Okay, let's dive right into this with Section 1, the efficient market benchmark. Before we can really talk about how markets get things wrong, we kind of have to understand the theoretical gold standard that assumes they get everything perfectly right. That benchmark is the efficient market hypothesis, or EMH, developed by Nobel laureate Eugene Fama. Essentially, the EMH claims that asset prices flawlessly reflect all available information, all the time. It comes in 3 flavors. In its weak form, prices reflect past data. In the semi-strong form, they reflect all public information. And in its strong form, they reflect absolutely everything, even private insider data. Think of it like a perfectly balanced scale. The textbook assumption here is that if everyday biased investors make mistakes, well, the smart money will instantly swoop in, correct the price, and rebalance that scare. And this beautifully illustrates our core tension. On one hand, you have the textbook assumption. Investor errors are rare, they're completely independent, and smart money effortlessly eliminates any mispricing. But the behavioral finance correction argues something entirely different. In reality, investors are biased, we're attention-constrained, and we're heavily influenced by social cues. And crucially, as we'll see, arbitrage is strictly limited by capital, risk, and career constraints. Because of this, prices actually can deviate from fundamentals for sustained periods of time. But hey, before we completely throw out traditional financial theory, we have to acknowledge a massive hurdle called the joint hypothesis problem. Whenever we spot a portfolio earning abnormal returns, we face an inherent tension. We literally can never know definitively if the market is actually inefficient or if we're just using a flawed asset pricing model to measure the risk. Every single claim of a market anomaly is always tangled up with our underlying model of what a normal return should even be. Which brings us to Section 2, the limits of arbitrage. Yes, an anomaly might exist, but can it actually be safely traded? Schleifer and Vishny identified a brilliant mechanism chain that totally dismantles the assumption that smart money can effortlessly fix mispricings. Identifying an overvalued asset is absolutely not the same thing as being able to profit from it. Real-world arbitrage just isn't magic, It requires borrowing stock, which incurs steep fees. Some overvalued stocks literally can't even be shorted. And perhaps most importantly, fund managers face intense career pressures and institutional constraints. Bias only really matters for prices when it turns into actual demand, and the arbitrageurs are simply too constrained to offset it. Let's anchor this heavy theory with a canonical historical disaster: long-term capital management. LTCM was packed with brilliant minds who had identified genuine mispricings in fixed income markets. And guess what? Their math was actually right. But then, in the summer of 1998, the Russian debt crisis hit, triggering a massive global flight to liquidity. The mispricings they bet on didn't correct, they widened dramatically. Investors panicked, capital was withdrawn, and by autumn, the firm was completely destroyed. It is the ultimate proof of a harsh structural reality. Markets can remain irrational far longer than leveraged investors can remain solvent. Now, what's really interesting about this next concept is how it introduces unpredictable demand shifts. We're talking about noise trader risk, a concept formalized by DeLong, Schleifer, Summers, and Waldman. This is the very real danger that sentiment-driven noise traders will unpredictably push prices even further away from their fundamental value before a correction finally occurs. Rational arbitrageurs are forced to bear this costly risk. It's systematic, it's undiversifiable, and it completely shatters the illusion that arbitrage is some sort of safe, risk-free correction mechanism. So let's move into Section 3, volatility, noise, and bubbles. So what exactly happens when arbitrage fails and sentiment takes over the market on a massive scale? Well, look at this number, 5 times. This represents Robert Shiller's foundational finding on excess volatility. If traditional theory is right, stock prices should really only move when genuine news about future dividends arrives. But Shiller proved that stock prices actually fluctuate roughly 5 times more than can possibly be justified by variation in those future dividends. It was a total game changer of a revelation. It essentially proved that market prices are being driven by something far beyond just rational fundamentals. And that excess volatility, it paves the way directly for bubbles. Let's briskly step through Kindleberger's classic anatomy of a bubble. First, it starts with a displacement, a new paradigm usually fueled by a massive credit expansion. Then comes extrapolative expectations, where people assume prices are just going to keep rising forever. This triggers massive herding, and finally limits to arbitrage prevent the smart money from stopping the madness. A perfect example of this is the dot-com era, where Lamont and Saller documented something called negative stub values. There were literal tech companies whose total market cap was somehow less than their stake in a publicly traded subsidiary. I mean, it's a rational impossibility, yet it persisted because betting against that kind of mania was simply too risky. This dynamic also perfectly explains why we see both momentum and reversal in markets over different time horizons. As Barbaras, Schleifer, and Vishny explained, investors tend to underreact to single, isolated pieces of news, like a one-off earnings announcement. This creates short-term momentum. But when they see sustained sequences of success, they over-extrapolate, they overreact, convinced that the trend is completely permanent. And of course, eventually reality sets in, producing a massive long-term reversal. Moving right along to Section 4, Investor Biases and Herding. Let's shift our focus now to the specific psychological quirks that make up the so-called factor zoo of individual investor behavior. So, the crucial point here is that individual cognitive errors actually scale up to create massive portfolio and market distortions. Take overconfidence, which was heavily documented by Barber and Odian. This is where investors have false precision about their own skills, which leads to excessive, costly trading. Then there's myopic loss aversion, a totally brilliant concept by Benartzi and Thaler that actually resolves the famous equity premium puzzle. Basically, investors demand high returns for stocks simply because checking their portfolios too frequently exposes them to the outsized psychological pain of short-term losses. We also see the disposition effect, another fascinating quirk studied by Odian, where investors sell their winning stocks way too early just to lock in a gain, but hold onto losers far too long. And finally, naive diversification. This is the classic 1/n rule, where people just blindly split their money equally across whatever options happen to be put in front of them. But let's be totally clear here. This is definitely not just a retail investor problem. Sophisticated professional institutions herd just as much, primarily through two main mechanisms. First, in informational cascades. Rational investors actually doubt their own private data and choose to just blindly follow the crowd. Second, in reputational herding, it's about pure career self-preservation. Professional fund managers will intentionally match a benchmark because, honestly, it's much safer for their careers to fail conventionally alongside everyone else than to take a bold, contrarian stance and risk failing alone. And that brings us to our final section, Section 5, Ethics of Gamified Trading. Now, let's pivot to the modern era to examine how new technologies weaponize the very behavioral biases we've just been unpacking. I really want you to consider this question. When does platform engagement become exploitation? Where is that blurry line between an app simply reducing transaction costs and an app intentionally redesigning the psychological environment of retail investing? Modern trading platforms have fundamentally changed how we interact with financial markets, and it raises a really serious ethical debate. Let's look at the specific digital engagement practices that create these risks. You've got fractional shares, which lower the barrier to entry. Now, that sounds great on paper, right? But combined with push notifications, trending stock leaderboards, and celebratory confetti effects, the whole environment becomes incredibly gamified. These platforms are explicitly designed to harvest attention-driven buying. They essentially monetize the user by inducing high-frequency, excessive trading. And these are trades that these same investors likely would not endorse if they were sitting in a calm environment, just making informed, reflective decisions. We'll wrap up this explainer with a final provocative thought. Trading platforms will often defend their gamified features by claiming they're merely preserving the user's freedom of choice. But we have to ask, is preserving the freedom of choice an adequate ethical defense when the choice architecture itself is designed to manipulate boundedly rational users? Do retail trading platforms actually have a duty to protect us from our own cognitive limits? It's a massive question that sits right at the intersection of behavioral economics, financial regulation, and personal autonomy. I'm going to leave you to think on that. Thank you so much for joining me for this explainer, and remember to keep questioning how the world around you is designed.